I'm recording this from Dubai. I've lived here for 4 years. My family is here. This is home. Over the last few days, we've heard dozens of missiles and drones being intercepted overhead. Drone debris has damaged buildings across the city. Fighter jets have replaced the sound of airliners. Schools have gone remote, and it feels a bit like the early days of COVID. But the restaurants are still open, people are still on the beach, and life goes on, which is sort of the point of today's episode, because every investor listening to this is likely asking the same questions I asked Neil Woodford on Saturday morning. He gave me a framework, and today we're giving it to you. Welcome back to the Noise Cancelling Podcast. I'm John Adair, and with me, as always, is Neil Woodford. Now, we're not doing a war briefing today. You can get that from anywhere. But what you can't get anywhere is what we're about to give you, a decision framework for investing through a geopolitical crisis. By the end of this episode, you'll have 5 principles you can apply not just to this conflict, but to the next one and the one after that. We're going to teach the framework first, then stress test it against what's happening right now. Make sure you're subscribed so you don't miss future episodes, and leave a comment if you've got any questions as we go. Neil, you've invested through the Gulf War, 9/11, the Iraq invasion, the Russian invasion of Ukraine, the October 7th attack, and now this. You told me something on Saturday morning that I want to start with. You said the first thing to do in a crisis is ask one question. Let's look at principle 1. Is this a 4-week problem or a 4-year problem?
The one question is this conflict likely to fundamentally change the long-term cash flow generation, profits of the companies that I'm invested in? Is it going to fundamentally change the economic growth outlook for the economies that I'm exposed to? Those fundamental long-term questions. It shouldn't be focused on what's going to happen in the next 5 weeks, the next 4 weeks, what's happening today, tomorrow. It should very much be focused. A key question is, what is the likely impact on these longer-term, fundamentally important issues?
And we talked about the difference between a 4-week problem and a 4-year problem. Tell me, what do you mean by that?
When we say a 4-year problem, a 4-week problem, how long will this go on for? What will the impacts likely be on the oil price and global gas price? How long will those impacts last? How quickly can oil supplies, gas supplies return to normal? Those are some of the key questions that you need to ask. My instinct right at the start was that the duration of those challenges that we're likely to see in the very short term is going to be shorter than the impact of the war in Ukraine.
But how do you know which it is in the first few days? We're less than a week into this conflict. You're already telling me that you think this is a 4-week problem. Isn't that a bit premature to state that?
Yeah, it might well be, but I think you have to formulate a view, and you base that view on the information that you have at the time. Now, of course, you have to iterate that view. Every day there is new information emerging. Every day there are new impacts, more visibility on what's going on the ground. You're in a great position to understand that right now. So, our conversations have been pretty helpful in understanding some of the things I needed to think about. It's also important to think about the potential for conflict, this particular conflict, to widen. And by widening, I mean, one of the first things I asked myself was, is this confrontation between Israel, the US, and Iran, or the Iranian regime, and importantly, what's happened in the immediate aftermath of the conflict starting last weekend, the fact that Iran lashed out at all of its Gulf neighbors, and even more broadly than that. What was that likely to mean? And most importantly, in my mind, was, well, what is Russia, what is China going to do about this conflict? These are, in theory, sort of politically friendly countries to Iran. And so I spent quite a bit of time trying to understand what I thought would happen in those two examples. And my conclusion pretty early on was that they'll do nothing. And I think that's proved to be accurate. So those are the sorts of questions you need to ask yourself. Can this become a much wider, deeper conflict? How long is it likely to last? Can the Iranian regime continue to do what it's been doing in response to the war starting last Saturday? And those are the key questions I've asked myself. I've informed myself every day about what's going on. You've been really helpful in telling me on the ground what's happening in Dubai, for example, what's happening in the region. And I think broadly the conclusions I drew quite early on have proven to be correct so far. But of course, everything can change tomorrow, day after. Wars are unpredictable. And of course, casualties, particularly on the Israeli and the US side, can change perspectives. But so far, I think the sort of course of this conflict has mapped along broadly what I thought it would.
So the first thing you do, Neil, before you look at a single share price is ask whether this changes the world for a month or for a decade. And most conflicts historically are in the first category. The question is whether this one is as well. And we will come back to that later. The second thing you said to me on Saturday, which stuck with me, is you said that the selling that you'll see on a Monday morning is not the product of reasoned analysis.
It's obviously triggered by the event or the events, but it isn't the product of a reasoned sort of fundamental analysis of the implications of the conflict. Typically, financial markets react adversely to these sorts of things. I mean, 99 times out of 100, they overreact on day one. And that overreaction is driven by what's called positioning. What happens is that lots of financial institutions in the incredibly complex, arcane financial market systems around the world, lots of investors, lots of players at the margin in those markets have leveraged positions, have positions which are always intended to be very short term. And events like this always cause those investors to immediately look to take risk off the table. So what you tend to see is selling triggered by these sorts of, I hesitate to call them investors, these sorts of margin players, if you like. And it is that type of selling which immediately impacts financial markets. It's not the product of reasoned, in-depth analysis by really, really smart people. It's sort of hair trigger type reactions.
But sometimes the people who sell on day one are the smart ones. Sometimes they are the ones who've got it right.
Yeah, sometimes. It depends over which period you measure right. Did they get it right or get it wrong? If the market falls further in the second hour of trading, some might say that was a great decision. Because they buy back in, or they put new positions on. But for most investors who think longer term, you have to really think about, well, if I sell today, will I be able to rebuild that position at a lower price later, several weeks later, a month later?
I guess if you think of it kind of like a fire alarm going off in a building, everyone heads for the exit at the same time, not because they've actually seen that there's a fire, but because everyone else is running. That's what Monday morning is like in a crisis like this one, I think.
Often, yeah.
The question is whether you're running from a real fire or a false alarm. And to answer that, you need data, which is exactly where principle 3 comes in. Neil, you sent me a piece of research this week. I found it really surprising. What does the data actually say about investing during wars and crises?
On 70% of occasions when war has broken out over the last 50 or 60 years, on 70% of occasions, those who bought on the day that the conflict started were in profit a year later. The fact is that buyers actually make money a year on from the day of the conflagration in 70% of events, which tells you that people who sell typically in a panicky sort of way on day one are typically making a bad decision in most occasions. Not always, but on most occasions.
I went through this data as well, Neil, and for me, the one that stood out was the biggest loss, which was over 34% after the 1973 Arab oil embargo. So we're talking about the averages, but there's one big exception. It was an oil shock in the Middle East, exactly what people are worried about right now. How do you know this isn't 1973 all over again?
Well, that's one of the first questions you've got to ask. And of course, it was something that the media was talking about in the early part of the week. The fact, though, is that the fundamentals of the oil market have changed dramatically since 1973 in terms of the energy intensity of their economies, the oil in energy intensity of their economies. All these things are very important factors. The rise of the US as a major oil producer. The global oil industry was really triggered after that 73 oil embargo. Never again did the world want to be held hostage, if you like, by a very small number of Middle Eastern countries. And so it proved to be the case, that over a period of time, the world economy adjusted. Now, clearly, 20% of the world's oil still goes through the Gulf of Hormuz, and all of Qatar's gas that is exported to its near and far eastern customers goes through the Gulf of Hormuz. So it's it's a very important energy supply route. But the countries that put that embargo on in 1973 and that caused that sort of hyperinflation market fall in the 70s, those circumstances have gone.
Okay, well, here's where we are so far. More than 70% of the time, over 85 years of data, buying at the start of a crisis has been the right call within the next 12 months. The exceptions tend to be genuine structural disruptions, not short-lived conflicts. The question is, which category does this conflict fall into? And Neil, you've got a very specific way of answering that.
You have to do the analysis. You have to do the work. You have to think. That analysis led me to believe that it was much more in the bracket of what we've experienced on quite a few occasions in recent years in the Middle East, and not the sort of conflict, for example, and not the result of the conflict that we saw, for example, when Russia invaded Ukraine. There's one important caveat, though, which is that you really mustn't embed your views in tablets of stone. Okay, you've got to be iterating. Okay, because new information, wars are messy, so you've got to sort of look through the propaganda on both sides. You've got to try and understand what's actually happening, and be prepared to change your view if new information encourages that sort of reaction.
So the principle is simple. Don't compare the story, compare the numbers. War in the Middle East, oil prices spiking. That was a headline in 1979 and a headline this week. But the economy behind those headlines is completely different. We've built a side-by-side comparison, which we'll get to shortly. But every single comparison we make tells a different story to 1979. But there's one last principle I want to talk about. And you told me you write something down before the market even opens.
What I tend to do is focus on the things that would really worry me. What would I need to see happen that would make me change my view, my initial view, which is that this is a relatively contained, localized, short duration conflict. And for example, I went in my own mind through, well, how could this conflict widen? How could this conflict lead to some sort of confrontation, for example, between, say, Russia or China and the US? And I really couldn't see any process, any series of events where that was likely or could happen. So that was one of the things, and there were others that I went through. But I think it's a helpful exercise to do, just to write down the things that you would need to see to make you get more worried.
Okay, so write down your sell triggers, literally on paper, on your phone, whatever you've got to hand. It sounds simple, but it's probably a really good defense against panic selling. Because when you wake up and the market's down 600 points at 10 a.m., you don't need to make a decision. You've already made your decisions. So 5 principles. Now, here's what we're going to do for the rest of the episode. We're going to take this framework and throw it at the biggest geopolitical event since the Russian invasion of Ukraine and see if it holds up. So for anyone who needs a quick catch up, here's the situation in the Middle East as of today. On Saturday, February 28th, the US and Israel launched coordinated strikes on Iran. They killed the supreme leader, Khamenei, along with senior military commanders. Iran's navy has been largely neutralized and its air defenses are severely degraded. But Iran's hit back. Over 500 missiles and over 2,000 drones. Not just at Israel, at every Gulf neighbor. Being in Dubai, I can give you the picture here. We've heard dozens of interceptions overhead, missiles, drones. Drone debris has hit the Burj Al Arab, the Fairmont Hotel, Amazon's data centers. But no missiles have actually got through. The UAE's air defense has been remarkable. Flights are disrupted, but they are slowly resuming. Day to day, the threat to the general public feels very low. It's unsettling for sure, but it's not devastation. Qatar's LNG facilities were attacked. Saudi's main refinery took a drone strike. The Strait of Hormuz, as Neil said, 20% of the world's oil flows through it, is effectively shut. Not formally, but insurers have pulled war risk cover and commercial operators won't pass through unescorted. So about 200 tankers are stranded in the Gulf. Today, on day 5, reports are that Iranian operatives have secretly reached out to discuss terms. Publicly, Iran has denied it. Trump says this is a 4 to 5 week operation. He promises to ensure and escort tankers through the strait. Neil, that's the situation. Let's look at principle 1. Is this a 4-week problem or a 4-year problem?
My analysis was that this was a much shorter duration, whether it's 4 weeks or 5 weeks, or it's a much shorter duration than some were speculating.
It's about trying to gauge the order of magnitude.
Yeah. So it's a shorter term issue for me.
So, Neil, your call is 4 weeks. The conflict is contained. The military outcome is lopsided. There are already signals of negotiation. The question is whether the data backs that up. And for that, we need to go back to 1979. In 1979, we had the Iranian Revolution, the oil shock, the recession that followed. Neil, you've built a side-by-side comparison, and I think it's going to really surprise people. Take us through it, please. Give us the headline for each one.
Back in 1978, Iran was 8.5% of world production. It's now 5%. As you probably know, there have been sanctions on and embargoes on Iranian oil exports for many years. Middle Eastern oil production compares reasonably well, but it's down more than 10% in terms of its share of global energy production, global oil production. And the US has seen a very significant increase in its share of world oil production, reflecting that sort of trend that really started in the early 70s to diversify away from a dependence on the Middle East. Now, the world is still very dependent on Middle Eastern oil and gas, but the level of that dependency is reduced, but particularly in relation to Iran. Equally, the oil intensity, if you like, the oil energy intensity of the US economy has been transformed over the last 40 years.
And that oil intensity, just to explain, what that's telling you is for every dollar of GDP, it needed almost 4 times more oil than today. So the US economy is largely decoupled from oil.
Yeah, significantly less oil intensive. Of course, inflation is very different. Current inflation rate in the US is under half what it was back in 1979. The US market's multiple is a lot higher, and we've talked about that on previous episodes. That's entirely independent. But what you can also see is how countries in the region have been transformed in the intervening 40 years, and just the number of air passengers going through Dubai's international airport is just a sort of remarkable reflection of that complete and utter transformation of the economies in the Gulf region.
Neil, the PE ratio is the one that really worries me. We discussed it last week. Markets at 29 times earnings have a lot further to fall than markets at 8 times, which is what it was in 1979. Doesn't that make this conflict more dangerous?
In some respects, yes. You could argue that when you're priced for perfection, when something comes along that isn't perfect, then its impact might be more exaggerated. Interestingly, the most highly rated market in the world has behaved like the only grown up in the world, frankly, through this week. The S&P 500 has, I think, actually risen this week, which tells you all you need to know, really, about the US investor base's attitude to this conflagration, which is that it is localized, it's likely to be short in duration, it isn't going to sort of proliferate and result in any sort of wider confrontation globally. So you can see, even though the rhetoric might be different, even though the media might be full of alarmist headlines, you can see in a way, and I have to say I'm surprised by this, you can see in very clearly from the way that the S&P 500 has responded to this war, what US investors are really thinking.
That Dubai airport number is staggering. 92 million passengers. It's one of the busiest airports in the world. And that is just one data point for how much the Gulf has changed. These countries have spent 45 years building something extraordinary, and Iran just attacked every single one of them. UAE, Qatar, Saudi, Kuwait, Bahrain, even Oman. Neil, is that not the biggest strategic miscalculation of this whole thing?
I believe it is. I now I think I understand. For me, initially, I thought I just don't understand why Iran is striking out against its Gulf neighbors. Not just Bahrain, Oman, UAE, Saudi, but also as far north as Turkey, Azerbaijan. I understand has also had some incoming. So Iran has lashed out at everybody, and I'm told now that this is in part a product of first of all, when you've cut the head off of the sort of command and control infrastructure of the Iranian regime, to some extent, the decision making might be a little confused. Experts on Iran and the regime have said that this is a thought through process. This isn't just a sort of random sort of lashing out. This is thought through, and the motivation for these strikes on Gulf neighbors is the notion that by striking out, by inflicting economic harm and and terror, in effect, on the populations of the Gulf, you then incentivize and motivate them to put pressure on Israel and the US to end the conflict. From Iran's regime's point of view, that strategy has failed completely. Not only have the air defenses of the UAE proven to be more than a match for Iran's drone and missile capability, but what it has done has enraged those Gulf neighbors, and if anything, has aligned them more with the US Israeli perspective on this conflict. So it's failed, but that hasn't deterred the regime, which is continuing to strike what appear to be softer targets in the north, and that's why they've gone after targets in Turkey, for example, and in Azerbaijan, I believe.
There's one more thing on the 1979 comparison. In 1979, OPEC actually restricted supply, and that's what turned the disruption into a full-blown crisis. What is OPEC doing now?
The political alignment of the region is completely different now. Saudi's protector is effectively the US. The US has military bases throughout the region. Trump has gone out of his way to befriend the Saudi regime and others in the region. Clearly, obviously, he may not be the most popular politician in the history of US politicians, but nevertheless, US military might and presence in the region and its alignment with countries in the region, as well as Saudi, the UAE in particular as well, has done any number of deals with the US, not least recently on AI and technology sharing. So the fact is that these countries are now more aligned with the interests of the US, and it is clear that some pressure will be brought to bear. Whilst Iranian oil production obviously falls significantly, it is likely that instead of restricting supplies, which is what happened in 1973 and in 1979, instead of restricting supply, OPEC will be looking to increase production. And of course, there are substantial reserves globally. Interestingly, the biggest customers for Qatari gas and indeed Iranian oil, amongst the biggest customers, is the Chinese economy. So China will, in particular, be sort of keen to secure supplies, to see those supplies renewed, and will be keen to encourage, just as the US will, countries in the region to make good for the Iranian reductions. Now, of course, getting the oil and gas out of the region requires some stability to be brought to maritime operations in the region. But I'm absolutely sure that was the number one priority of the US one of the very highest priorities of the US military, and we know that the Iranian Navy has been completely taken out, it would appear.
Okay, so here's where we are on the 1979 comparison. Iran produces less oil. The US produces more and is now the world's biggest producer of oil. The American economy uses a quarter of the oil per unit of GDP that it did, and inflation is half what it was. Meanwhile, OPEC is doing the opposite of what it did in 1979. Every stat points in the same direction. This is not 1979. The structures are fundamentally different. The headline might be the same, but the economy underneath it is not. Okay, Neil, if the framework is right, we should see it in the market data. And the market data this week has been pretty fascinating to watch. What has jumped out at you, Neil?
I think what I mentioned already, which is the resilience of the S&P 500, that's been that has surprised me, particularly because you would argue, as you the point that you made earlier on, you would argue that on a very high valuation, you might have expected it to be more vulnerable. I think financial markets have broadly behaved as I thought they would, in that they were pretty nervous on the first few days, but in the last two have recovered and are up. Not significantly, but they're up. There is a better tone. I've been a little surprised by what's going on in government bond markets. There are fears about higher inflation across developed economies of the world as a result of the oil price increase, gas price increase. We'll have to see what happens, but it's clear that Donald Trump understands that a medium and longer term implication of higher oil prices, higher energy prices is very undesirable, certainly for the midterm elections at the end of this year. So I think he'll be doing all he can to ensure that traffic can resume through the Gulf of Hormuz. And that means, I mean, he's already offered U.S. escorts for tankers. The Iranian Navy, as I've said, has been completely eroded as a result of the attacks. And I'm also told, by the way, that the Iranian stocks of drones and missiles, ballistic missiles, their ability to keep firing with the level of intensity that they have in the first few days of the war has been significantly eroded. You've told me, John, you can see that on the ground in Dubai. That backs up what I'm hearing from experts who follow the Iranian regime's military capability. So my view is that this understandable and temporary interruption to oil and gas supplies from the region will be just that, temporary.
The US isn't the whole story, of course. The Dubai and Abu Dhabi exchanges were closed for 2 days. They reopened yesterday, Wednesday. They were down 5% and 3%. But South Korea's market fell 18% over the 2 days, probably the worst since the financial crisis. What do you make of that?
I think these markets are quite narrow. I mean, Samsung and SK Hynix are two of the biggest companies in the world, actually, and dominate the Korean exchange, and both have performed incredibly well in recent years, and certainly in recent months, and we're just vulnerable to profit taking. So I don't particularly I don't ascribe too much sort of significance to that Korean market setback.
It's probably just the areas with most exposure to Gulf energy supply.
Yeah, I mean, South Korea is a big customer for Qatari gas, a very big customer. But I think it had much more to do with what I said right at the start of the call about getting risk off the table. Clearly, the very strong performance of the semiconductor sector has been a big factor in markets in the last 18 months. Samsung and SK Hynix, as I've said, are massive companies in the Korean index, and we're just ripe for a bit of profit taking, I think.
Okay, let's get to the number everyone's watching, which is oil. Whereabouts are we on that?
Well, it depends which one you're looking at, but I was looking at Brent crude, also looking at the futures market. I mean, clearly the first 2 days of the war saw energy prices spike. Oil prices were above $80 a barrel. Brent is typically more expensive price per barrel than is West Texas, but it looks to me like oil prices are down today. They've stopped going up; they're coming back down again. One of the measures that I looked at, which was a futures market, oil price spiked to above 80, and it's currently trading at $76. So, the very big spike that we saw in previous conflicts isn't happening right now. And indeed, interestingly, the price has yet on the measure that I was looking at has yet to breach where it got to in June last year when the Israelis and the US bombed the Iranian nuclear facilities in June.
But the strait is shut right now, and there are 200 tankers stranded without insurance to go through. And tanker rates are at an all-time high, $424,000 a day. How can oil only be at $82?
Well, there's a huge amount of oil storage. Lots of countries have invested in significant storage capacity to ensure that shocks to supply don't immediately translate to problems on the high street with higher inflation, higher oil prices. So oil inventory is very, very significant globally, as is energy infrastructure, energy storage infrastructure, particularly with respect to gas. I mean, it's better in some countries than others, but there are sort of shock absorbers in the system in the way that there weren't back in 1973 or in 1979. So that's one of the reasons. The other reason is I think that people are taking the view that certainly in the Northern Hemisphere is going into the summer where demand for energy obviously decreases as well. That's the important thing to bear in mind. And my sense is that also the oil market, the gas market is sort of looking at this conflict and day by day becoming slightly more confident that it is not going to be a longer term disruption to supply, that some normality will return to the region relatively soon. And that's in part the product of the sort of military superiority that has become incredibly visible in a matter of days in this conflict. It is clear now that the Iranian regime's not only is its leadership now mostly dead. I mean, of course, there are other people who are coming through, but important leadership has been taken out. Their air defense system has been taken out. Their air force has been taken out. Their navy has been taken out. Their supply of their ability to re-equip and resupply has been severely eroded. Their stocks of drones and missiles have been severely depleted. They just will not have, in my view, based on what I'm hearing, based on what I'm listening to in terms of expert opinions, they will not have the ability to prolong this conflict. And that's why behind the scenes, important leaders who are sort of emerging as the potential new leadership of Iran appear to be reaching out to the US to negotiate.
Gas is the other one making headlines, of course, especially in the UK. The European benchmark nearly doubled in 48 hours.
As much as the gas price increased significantly as a result of this conflict, in the context of what the gas price did when war broke out in Ukraine, in Europe, the gas price, the European gas price, is just a little pimple in relation to that spike that was, as I said, prolonged to the beginning of 2024. Yes, gas prices have gone up. That could result in an increase, for example, in the UK, if they're prolonged. That could result in an increase in the energy price cap, for example, in the UK. I've just done some numbers this morning based on a reasonable estimate of the continuation of the current spike. You might see an 8% increase in the energy price cap for the next 3-month period. I'm pretty sure the government would probably do something about that and intervene to stop that. But it's just come down by 7%. So an 8% increase, albeit that not welcome and would it result in an increase in inflation, would certainly not completely derail the outlook for the economy at all.
Okay, so it seems like the market is pricing in a short disruption, not a structural crisis. Goldman's maths says the war premium built into the oil price right now implies about a 4-week conflict, which lines up exactly, Neil, with what you said on day one. The one thing to watch, if Hormuz stays closed beyond that window, the numbers could change materially. But right now, the pricing is consistent with your framework. Now, Principle 5 says define your escalation triggers in advance. So let's do that now. The specific things that would change this from a 4-week problem to something worse. I'm going to go through them one at a time. And Neil, you can tell me how each one stands today. So trigger 1, China or Russia entering the conflict.
I would put a near zero chance on that. even lower than I did on day one.
Trigger 2, Strait of Hormuz staying closed beyond 5 or 6 weeks.
I struggle to see how, given the military superiority in naval terms, in air superiority, how the regime in Iran has the capability to continue to disrupt shipping through the Gulf of Hormuz beyond, the next few weeks.
Trigger 3, large-scale destruction of Gulf oil production infrastructure. So not just transit disruption, but actual damage to the places that produce and process oil and gas.
Look, I mean, one has to always, as I've said, remain open to new information, new inputs, and I don't have by any means a sort of perfect foresight on what plans might come to pass, or what targets the Iranian regime is going to focus on. But my sense is that they have already tried and failed to disrupt and damage oil infrastructure in the region, in both the UAE and in Saudi, and they have largely failed to do that. So my guess is that we're past the point of maximum danger on that front.
Trigger 4 is the one we all want to avoid: nuclear escalation.
This whole conflict really is about the nuclear challenge, the nuclear threat. I think in the past, the UN, previous US presidents, even Donald Trump in his first term, were prepared to permit the Iranian regime to enrich uranium up to a point. And I think the world sort of looked the other way, whilst it was broadly known that Iran was building a nuclear weapons capability in one form or another. I'm not sure that Israel, for example, would ever have accepted that, by the way. And this is where, the maximalist demands of Israel and the US now seem more aligned than they might have been in the past. But now Donald Trump, I think, has made it very clear that there is going to be under his regime, under his presidency, there will be no acceptance of Iranian enrichment capability. So this is really about a new maximalist sort of perspective on Iran's nuclear program, and in that, I believe the US and Israel are aligned, and of course, ongoing Israel. I'm led to believe, for example, that after the strikes on the Iranian capability back in June last year, Israel was keen to go again in February of this year and was talked down by the US administration in February this year. But you can see now how the two are more aligned in terms of what they've agreed to do in relation to that capability. And that is going to be a key point, I think, in any sort of negotiations that take place to bring this conflict to an end.
Okay, well, that was Neil's checklist. 4 triggers. China and Russia's involvement, seemingly not happening. The Strait of Hormuz closed beyond 5 to 6 weeks. This is probably the one to watch, but the direction seems to be towards reopening. Gulf infrastructure destruction at scale. There's been some damage, but it's not yet systematic. Nuclear, probably off the table. None of the 4 triggers are firing today. Now, of course, that could change at any time. But if that does change, the framework tells you to reassess. Of course, that's not advice. Everyone has to make their own decisions and come up with their own framework. Neil, there's something you said in your note that I think is probably underappreciated. You think the long-term consequences of this could actually be positive for the region. I have to say I'm incredibly grateful for the protection that the UAE has given to my family and to me. But I can see how hearing interceptors going off overhead and seeing schools go remote could make it a hard sell for some people. Tell us why you think this could end up being positive.
Iran has been a sponsor of terrorism in the region, has been the source of huge instability in the region for decades. The Iranian regime since the late 70s has been a disruptive force, if you like, in the region, albeit that regime change is not an explicit sort of priority of this conflict. It is clear that many interests are aligned in seeing a more stable Iran, frankly. there are huge potential benefits to come, not just to the region, but I think to the world economy from a more outward-looking, less insular Iran. And I think to some extent, regime change is almost by definition happening because of course the supreme leader is now dead, and many of his sort of near lieutenants are also dead. So a new leadership will emerge. Whether that will be a pragmatic leadership that will seek to negotiate, to bring this conflict to an end, and to lead Iran down a different path. It may not be the wholesale regime change that some external observers would like to see, but nevertheless, there is almost by definition going to be regime change. If it is not yet clear at all whether that will result in the sort of outcome that would make the whole region more stable and more attractive for investors, for whether Iran would be outward looking and start to reintegrate with the world economy. We don't yet know that, but that has to be a hope. It's experts who I've listened to comment in the last week have told me that this is not a high probability outcome. The number one priority of the regime is the sustainability of the regime. But nevertheless, you have to think that somewhere, somehow, pragmatism will, and a different path may well start to look much more appealing to a new leadership in Iran.
So, Neil, your longer-term view is that this conflict might actually end up removing the single biggest source of instability in the Middle East. The terror groups would lose their sponsor, the Gulf states would unite, and there's at least a possibility of a very different Iran on the other side. Of course, that's the optimistic case, and it's not unreasonable. The pessimistic case exists too, and we'll keep watching it, but it's worth noting that the markets seem to be leaning towards the more constructive scenario. Neil, thank you so much for that. I want to close by pulling together what we've covered today, because I think there's something here that goes well beyond this specific conflict. You now have 5 principles you can use anytime the world feels like it's falling apart. 1, ask whether it's a 4-week problem or a 4-year problem. Most geopolitical shocks are in the first category. This one looks like it could be too. Number 2, don't confuse Monday's panic with actual analysis. The first 48 hours of selling is often mechanical. It's positioning, not fundamentals. This week, the Dow dropped 600 points at the open and was flat by the close, and that tells you something. Number 3, check the base rate. Over 85 years and 40 major crises, buying at the onset has produced a positive 12 months return, more than 70% of the time. History doesn't guarantee anything, of course, but it should make you pause before hitting sell. 4, compare the structures, not the headlines. Oil shock in the Middle East sounds like 1979, but the US produces more oil and uses less of it, and the economy is fundamentally less exposed. 5, write down your sell triggers before the market opens. We're not telling you, of course, what to do with your money. We're sharing how we think about it. Do your own research, talk to a professional if you feel like you need to. But the framework matters more than the headline. And right now, the framework says, don't let the noise make your decisions for you. That's it for this week. If this helped you think a bit more clearly about what's going on, please share it with someone else who needs to hear it. If you've got a question or if you disagree with any of this, drop it in the comments. Neil and I read all of your comments and we'll pick some up in a future episode to answer. Neil and I will be back with more next time. Until then, take care.